More banks are on the verge of collapse, massive ones worth over $1 trillion. And I'll show you what the president has to say, as well as senators saying that Jerome Powell, the Fed head, is dangerous on the job. And I'll let you hear them and why, all in this video. Let's jump right in. Nearly $100 billion in deposits have been pulled from banks here already. If that's not a run on the banks, literally. But officials are calling the system sound and resilient. And this comes after the second and third largest bank failures in the U.S. to fail ever happened here just within the last several days. Silicon Valley Bank, second largest bank failure ever, and Signature Bank, the third largest bank failure ever in the United States, all here within the matter of the last 30 days or so. Yeah. However, Treasury Secretary Janet Yellen and Fed head Jerome Powell both stopped short of saying that everybody's deposits would be guaranteed. They can't do it. This is a significant problem. This means that our entire banking system is not guaranteed. This is because of what's known as the domino effect. If one massive bank fails and another massive bank fails, this is because they're all kind of invested in similar things. This is what happened with Silicon Valley Bank, worth over $200 billion. And they were invested in actually long-term treasuries, was one of the things they were invested in what the government tells us is safe investments. And what happened is, because the Fed keeps raising interest rates, and when they raised the interest rates, it actually made the value of their long-term treasuries go down to the tune of billions of dollars. And, well, this actually made it interest rate sensitive. And the Fed actually does it, or I'm sorry, the Fed's checks to see how solvent these banks are and how interest rate sensitive they are. They don't even check for interest rate sensitivity. They only check for credit sensitivity. Yeah, for solvency. So this is a problem here. Yeah, you guys can let me know your thoughts here on this. But and then what happened here is that they announced that they needed to raise $2 billion, and everybody seen the writing on the wall and started withdrawing their money quickly, creating a run on the bank. And now you can see the headlines here. Over $100 billion from other banks collectively have been withdrawn. And if you think your bank is safe, well, it may or may not be, because according to recent independent stress tests, 186 other banks in the United States could go the way of Silicon Valley Bank and Signature Bank. These are banks worth billions and trillions of dollars. And now, in addition to this, just here, basically like today, Deutsche Bank, one of the world's largest banks, I'll show you here in a second, tumbles as jittery investors seek safer shores. In fact, on the list of the world's largest banks here in the world, this is not just the US, this is the world's largest banks here. Deutsche Bank is listed here as the 22nd largest bank in the world, with 1,505 billions of dollars, which means it's worth $1.5 trillion. Yeah, that's a lot of money. And now they are having a run on the bank type of situation here as well. Massive liquidity crisis. This is now a contagion happening on a worldwide scale. Yeah, shares of Germany's largest bank, that's a worldwide bank, plunged on Friday as investors fretted that regulators and central banks have yet to contain the worst shock to the sector since the 2008 global financial crisis. Wider indicators of the financial market stress were also flashing, with the euro falling against the dollar, Eurozone government bonds yielding sinking, and the cost of insuring against bank defaults surging, despite assurances from policymakers and global banking systems saying that everything is safe. In the latest effort to reassure investors, the U.S. Treasury says that the Financial Stability Oversight Councils agreed at a Friday meeting that the U.S. banking system is, quote, sound and resilient. The meeting was chaired by U.S. Treasury Secretary Janet Yellen, whose comments are being closely watched. Now, here's what U.S. Senator Elizabeth Warren has to say about Fed head Jerome Powell. Take a listen here.
We've called for an investigation of the Fed, arguing that Jerome Powell has failed. Now, his defenders say the pandemic was a black swan event that sent the economy into a tailspin, and he has correctly read the labor market's ability to sustain full employment in the face of rate hikes. What do you say to those who disagree with you, and argue Powell, since of this unprecedented cataclysmic economic event of the pandemic, that he's actually done a decent job?
Well, you know, if you want to treat this as a cataclysmic event, which certainly the pandemic was, keep in mind it drove inflation in ways that are different from how we usually have it. So, for example, we have seen supply chain kinks that have driven up prices. Then add to that, we have a war in Ukraine. And then one of the big pieces has been a lot of price gouging. We've seen these giant corporations, particularly in industries that are very concentrated, really pushing their prices up. So there are three things that are helping push prices up. And do you know how many of those three can be affected by raising interest rates? None of them. The whole point is that Powell is using the one tool the Fed has, and that is raise interest rates. But he has said himself in hearings, nope, it won't affect any of those things. But here's what it will affect. When the Fed uses language like we're trying to cool the economy or slow down the economy, the translation behind that is we're trying to increase unemployment.
Right.
And in fact, the Fed has said this. In the last hearing that I had with Chair Powell, when we had him in front of us in the Finance Committee, I looked at the Fed's own predictions, their report in December, in which they said, we want to keep trying to slow down the economy, and what we're hoping for out of this is that we increase unemployment by 2 million jobs. Now, that's a lot of people for whom that's a lot of hurt. These are people right now who are paying the rent, putting groceries on the table.
Sure, they're not hiding this, though.
That's
I mean,
right.
they're saying this. He said it today. I think more than 1 million jobs to be lost this year because of these rate hikes.
That's right. And actually, by the Fed's own prediction, it's more than 2 million. That is their target here. And the point I want to make is that's not going to help us on supply chain kinks, not going to help us on the war in Ukraine. It's not going to help us on these the price gouging from these big corporations. So I think we ought to be not doing the these extreme interest rate hikes. We've never seen hikes at this rate in the modern economy, and bearing down harder on these other costs that are these other factors that are driving up.
But you
costs.
think Fed Chair Powell should be doing things about these other things that are causing?
No, I think what he should say,
Right.
he should call, for example, for more on price gouging, but back off using his tool and keep trying to say that he's going to keep using it until he puts 2 million people out of work.
So a December Washington Post column said that this is not the Warren presidency, but it's certainly a Warren-infused presidency, meaning that President Biden, is taking a lot of your suggestions and trying to enact them into law. Have you ever directly told President Biden that you think he should fire the chair, fire Jerome Powell, and who would you like to see replace him?
So I'm not going to talk about private conversations, but what I will say is I've made it very clear as publicly as humanly possible that I didn't think that he should be reconfirmed as chair of the Fed, and I think he's doing a really terrible job. And he's doing a terrible job on both fronts. Remember, there are only two jobs for the Federal Reserve Chair. One is monetary policy, inflation. I think he's doing a very bad job there, and it's risking pushing our economy into a recession. His other job is regulatory oversight, and he has spent 5 years weakening regulations over these multi-billion-dollar banks. I predicted 5 years ago the consequence of that kind of weakening would be that we would see these banks load up on risk, build their short-term profits, give themselves ginormous bonuses and big salaries, and then some of those banks will explode. And that is exactly what has happened on Chair Powell's watch.
So what are your thoughts? Should the Fed keep raising interest rates, which is just going to hurt average, middle, and low income Americans? You can see here, the Fed has actually raised interest rates 9 times in a row now since last year and the beginning of this year. 9 times in a row, a historic first. So, and this raises literally anything that has to do with loans, car loans, mortgages, student loans, personal loans, credit card interest rates. Anything you pay interest on is likely costing you more. Low and middle income Americans literally taking it on the chin, as 2/3 of Americans are already living paycheck to paycheck. You guys can let me know your thoughts in the comments. I will keep you up to date here on our YouTube channel. And if you haven't yet, make sure to subscribe down below and click the bell icon so you don't miss out on new videos that come out here on our YouTube channel every day at 10 a.m., 3 p.m., and 8 p.m. Eastern Standard Time. It's the best price there is. It's completely free. Here's some videos you should watch next. Here is some shocking news for seniors, people on SNAP, and low and middle income Americans as well. Click on that video if you haven't yet. Or this video to see what the Pentagon just did with a massive warning. So click on one of those videos next. Thanks for watching, guys, and I will see you in the next video.